Good morning. Thank you, Emilio, for the introduction. I think you know about me more than my wife now. And actually, as Emilio said, my first two papers in the best journal were published as I was a student. What I'm telling you that it's not a talent, it's curiosity, motivation, luck, and maybe 10% talent. But it's a lot of luck and motivation. If you want to work hard and curious to understand what you read, you do research. And I think talent is coming after that. And if you have a problem that I don't know how to solve, but it's a good idea, you go to the mathematics department and ask help me to solve the problem, the technical problem. So what I think is motivation, motivation, motivation. This is what I believe in. Now, about my lecture, I think after the introduction by Emilio, which is so great, I only can disappoint you, but I'll try not. And I selected, one more thing. I would like to thank the organizing committee, which did such an excellent job in this organization, at least from my point of view and from my experience. Now, the topic that I selected is the investment in stocks and bonds. And why I selected this topic? For two reasons. First, I know maybe three reasons. First, I know that many people do research in this area. Secondly, those who are not interested in this research probably have some saving money, so at least you learn how to invest. And thirdly, because there is a debate in the literature for the last 70 years. Are stocks better than bonds in the long run or not? And in a minute, you'll see the first slide. Now, actually, if you want to invest for 1 year, we know from economics, Markowitz, Samuelson, Merton, all what you have to do, put your preference or utility function, and find the optimum diversification and how you diversify. This is very optimal. However, every investor has his preference, so we don't have, or her preference, so we don't have some general rules. However, when the horizon increase, the investment increase, you invest for 10 years, 15 years, 20 years, investing for pension, for example, for retirement, you want to select the proportion, stocks or bonds, then we may be able to say something about all investors. We don't need to know their preference. And this is the whole idea. And the debate is very long for the last 70 years. The first thing that most people don't know, that the variance, WT is the wealth of your investment, random variable. You invest, let's say, for 10, 20 years, say in stocks. The variance of the log of the return, the wealth, is the risk index only for T greater than 20 years. Why 20 years? I'll show you in a minute. If you take 10 years, this is not the correct risk index. You have to find something else. Okay. Secondly, for about 20 years, I say about, you see in a minute why, the optimal investment rule is not Markowitz mean variance. It's mean, you want to maximize mean, and you want to minimize risk, which is the variance of log. Notice please here that we use two dimensions. Here wealth, here log of wealth, which most people don't know in the literature. This is the way to do it. And I'll come in a minute to explain to you. Now, the efficient frontier in this space is not Markowitz efficient frontier like hyperbola. It's something different, as you see in a minute, because we don't have here variance of W2, but log W2, it's messed the thing around. Okay, the stock weights. One of the questions is, if you invest for long run and you diversify between stocks and bonds, what happened to the proportions? So the result is that I obtain that the stock weight in the minimum variance portfolio, which is the minimum variance portfolio, all of us know what it is, decreases to T. T is the horizon, indicating that stock become riskier as T increases, at least for T greater than 20, which means stock become riskier as you invest for the long run. This does not mean they're not good, but riskier. You see in a minute, there is an argument in the literature about it. In a minute. Okay. What I come to the conclusion, there is no one risk index for all T. And therefore, I need to use stochastic dominance. For example, if you invest for 1 year, you may be able to use the mean variance of Markovich. If you invest for 10 years, you're not allowed, and I show you in a minute why. So if you want to compare investment for 1 year and 10 years, we have no tools. We have no measure of risk. All of us agree that profitability is measured by the expected return. But risk, we don't know how to measure it. You see in a minute the argument in the literature. Please continue. If I assume IID, identical independent distribution, and I take the last 100 years rates of return on stock and bonds from the United States, where we have ample of data there, surprisingly, I found that the cumulative distribution function of stocks and bonds intersect only once. Only once. There's no case that they don't intersect. They intersect. If they intersect, we don't have stochastic dominance. We cannot say all investors, independent of their preference, prefer stocks to bonds. We cannot, because they intersect. You see in a minute. And I was surprised that for all T, I got only one intersection, and I did a bootstrapping, taking the 100 years annual rates of return, and bootstrapping 5,000, 1 million, got the same result. And this for all T. Now, this conclusion, a stock strongly dominates bond by probability dominance heuristic. What is probability dominance? We may have a case that one asset dominates the other by first degree stochastic dominance, but the returns are arranged in such a way that the inferior distribution has a higher probability to win than the best one by 90%, 70%. This is a paper which is now revised and resubmitted to Review of Economic Statistics, and I think it will be accepted very soon. And in experimental economics, most people ignore expected utility, ignore almost everything, and just say, what is the chance that I will be ahead? This is called probability dominance. And this is a new rule that I think we'll hear about it more and more in the future. Now, some people ask me, what if you have sampling errors? Because, even if you take 5,000 observations, you still have sampling error. So I incorporated also sampling error and find that there is almost FSD. No, there's no FSD, but we see the A, almost FSD. Almost all people prefer F2G. When I say almost, suppose I take all of you as the population. One of you have very pathological utility function. You say, no, I prefer G, I prefer bonds. But 99% of you, even more than that, actually 100%, would prefer the stocks. This is called almost stochastic dominance. I'll explain on it in a few minutes. And people can criticize me. By the way, just one comment. What I'm showing you now is not complete research yet. I'm working on it. So any welcome comments, I welcome them, any comments. And in the first, I think, slide, you saw my email there. If not, just Google Haim Levy, write me, and I'll be glad to hear your comments or any question that you ask. Okay, so far I assume IID, identical independent distribution. When I said no, but maybe stocks are correlated over time, so let us include dependence of return. And when dependence, of course, I have less observation, because what I do, suppose that investor invests for 5 years, I take the first 5 years, then the next 5 years, etc. So the years may be dependent. Mean reverting, you probably heard about it. So in that case, I got also that there is almost FSD for horizon of 6 years or more, as well as by probability dominance. So stock dominates bond for most of us. For horizon 6, 7, 10 years, most of us should invest in stocks rather than bonds. As I told you, the question about what is the best for us to do for retirement, for the long run, is an old story. The first one are Kelly, Latane, JPE, I think 1959, Harry Markovich, Journal of Finance. They proved that if you choose the portfolio or the asset with the highest maximum geometric mean, calculate geometric mean of all assets, take the one with the highest, then this will end with greater wealth for any other strategy. You can choose any other strategy here. This will win with probability 1. With probability 1, this means almost surely you win. So, for example, if bonds give you $10, stock give you $11. If bonds give you 8, then you get 9. Almost surely will end up better off. However, the problem with this, they talk about in the very long run when n approaches infinity, which is a problem for investors. Please go on. Okay, Samuelson and Merton in '74 disagree, and they say the following: look, if you take the myopic utility function, anyone who worked with this, now with this function, the investment optimal diversification is independent of the horizon. What you do for 10 years, you do for 1 year. Independent. So they tell Markovich and the other guys, how can you claim the geometric mean is winning? Because I know that no matter what is the horizon, I have here some risk aversion parameter, and I know how I diversify, and I'm not going to change it. This is not affected by the horizon, which counter to the previous result. Okay, the problem with this, Samuelson and Merton are correct only because, you see this function? This is the derivative. When W go to 0, the derivatives go to infinity. You see, if you derive this function, you get simply 1 over W in alpha. With W 0, you get 1 over 0, infinity. This causes all the problems. The difficulties with the two approaches. Because you have marginal utility going to infinity. When you have infinity, you don't know how to handle it. Okay, this is the problem. Please, next. Okay, now I'm talking about the approaches in evaluating the bonds and stock, and I told you this is 70, 80 years old debate unsolved. When I say unsolved, look why. There is Jeremy Siegel from Wharton. He wrote a book, and I think in the New York Times they say this is one of the 10 best books published in the United States. And he claimed the following: the risk of stock decreases with the horizon, decreases rather than increases, which means he say the longer the horizon, stock becomes safer. And from T up to 30 years, stock become less risky and more profitable than bonds. And he came to the conclusion, for any set of 10 years, he took 10 years out of 2 centuries he took of data, pick any 10 years if you want, calculate the maximum loss on stocks and bonds, and he found that on stocks you find the maximum loss is 4%, on bonds 5%. And what is his conclusion? If you invest for the long run, stocks are safer, more profitable, and the damage that you can is smaller by stocks. Okay, this is in his book, which is so cited in the Wall Street Journal and many, many articles. Please, next. However, Pastor and Stamba, by the way, he was the editor of the Journal of Finance, so of course, as you know, he can publish there anything that he wants. Because it's quite a close circle, and I'm wondering somehow how I penetrated there, because I'm not their friends, but I did. And they say the following. They did a paper in 2012, look, 2012, Journal of Finance, and look what they say. They say that the variance expression, what they said, I'm sorry, just 1 minute. Here's the emphasize. Our conclusion that stocks are more volatile in the long run. They're afraid to say the word risky. Volatile. Volatile is kind of vague, okay? They don't say more risky, more volatile. But when you read the paper, they say that they're more risky. They are more risky than bonds. Just counter to what Siegel says. He just, one slide ago, I showed you that he said they are safer. They said, no, they are more volatile. And they attacked Siegel in this paper. Okay, please, one more. And they said correctly, in order to measure if stocks are better or worse than bonds in the long run, what you have to do to include other
information, other assumption, or other factors to be taken into account. First, IID uncertainty. We are not sure the stocks are identical independent distribution. Maybe there is dependence over time. Mean reversion, the whole idea of Siegel, that when stocks goes down, as we have these days, don't worry, go sleep well, they'll go up. There is mean reversion. The losses and gains are compensating each other. At the end, you're making 10%. Don't worry about it. By the way, which I quite believe in that. They said you should uncertainty about expected return, uncertainty about current expected return, and estimation risk. If you take all this into account, they come to the conclusion that the combined effect overweight the mean reversion. Remember, mean reversion makes stocks better than bonds. Because if you lose, then you gain the next year, and ignore the risk. And they said no. If you take all these factors, stocks are more risky than bonds, and look what they publish in Journal of Finance, very long paper, very long paper. And no, I don't want to say this sentence. I'll stop here. Next slide, please. Okay. And they understand that it's unreasonable that bonds better than stocks in the long run. They understand intuitively, even though their models show the other way around. And then they say at the end, okay, maybe stocks are not so bad. Maybe stocks are better if you include some non-financial, or I would say non-conventional financial factors like human capital. If you take human capital into account, then maybe stock would do better than bonds. But they left it this way. And my question when I read the paper from two finance people, if you say that there are many, many factors, they didn't mention profitability at all. Why human capital? Human capital on top of profitability. First, suppose that stocks are riskier than bonds. I agree. But they are more profitable. Give you an example. I give you $1 with probability 1/2, and $100. No, I'm sorry. Let's repeat. $2 with probability 1/2, and 100 probability 1/2. This is stocks. And bonds, I give you $1 with certainty. Of course, stocks have higher mean, higher variance, but because of the mean, you buy the stocks. They didn't mention the mean here. Just human capital. I don't know where from they took it. Okay, next. There is a paper, I want to emphasize how important this issue in the long run. Abramov, which is a colleague of mine in Jerusalem, he published in Journal of Finance 18, just recently, okay? And he wanted to attack Stamba and Pastor, the previous paper, but he knew that he cannot publish this way. So what he did a paper and show some mathematical condition that they are right and some mathematical condition that they are wrong. So as you see here, he writes, if you take prior for some period, stocks are quite safe over the long horizon, which means stocks are not risky. However, another model that he built, they are as risky or even riskier for the long horizon investors, which means we need one-hand lawyer. We got two-hand lawyer here. So you have to choose the hand. So I talked to him, and he said, this is the only way I could write the paper. Or I would say publish the paper. Okay, next, please. Now, the question that we really need to ask. One, as the horizon increases, do stocks become riskier or safer? This is the question that Abramov, Siegel, Stamba, Pastor from Chicago, all these guys argue between them. So is it riskier or less riskier? They call it, are they more volatile? Siegel say risk. They say volatile, but they say the same thing. Are they more riskier? But I think this is not a very important question. The most important question is, the more relevant question, should one increase or decrease the stock weights in the portfolio as the horizon increase? Do stock dominate bonds in the long run? Which means if I invest for 10 years, should I put 20% stock? If I invest for 50 years, should I put 80% stock? This is the question. Not if it's more risky. We need to find all the parameters. Risk, return, skewness maybe, et cetera, et cetera. Please, next. Okay. the mean variance return and the variance of the log return. First, I wanted to know the data. So I put here horizon up to 60 years. Very few people say for 60 years, but I take 40. Here's the expected return. And this is the variance of return. And this is the variance of log return. You see what happened. Clearly, the variance increases tremendously. Look, up almost infinity when you go to 60 years. 1,000. But the mean return also goes up. And the variance of log return, I mentioned this because the variance of log return may be very important risk measure, as you see in a minute. So here, it's for the S&P 500 stock. This is only stocks. And if you ask, are they become risky, more volatile? The answer is clear. Everyone knows it. Okay, please next. And look what I did. Maybe one comment before I continue. Stamba and Siegel, when they argue between them, how do you compare risk for 1 year and risk for 10 years? There are 2 dimensions. They know that for 10 years the risk is much higher. So what they suggest, let us annualize it. Is it correct? I don't think so. And actually, I don't have the answer yet. Anyone of you who have an idea, I would like to hear it. Suppose that you have some risk coming 10 years ago, next, in the future, and one risk coming 3 years in the future. How do you compare them? Do you discount them? You're not allowed, I think. What do? They didn't know what to do, so what they do, annualize. Say, okay, let us annualize everything, and they divide it by T. Even if I do it, I take the variance. Look, this is the variance of WT. WT means the wealth if you invest for 2 years, let's say 50 years. So I calculate the variance. By bootstrapping, I find the whole distribution. I have variance. I can measure the variance. Okay. And this formula, I don't know if someone knows of it. It's not mine. It's James Tobin, Nobel Prize laureate. He wrote in 1965 this formula, connecting the multi-period variance. This is the multi-period variance. This is the one-period variance, one-period mean. And there is mathematical connection between them, so long there is IID. The rate of return are IID. You can develop this formula, not very complicated. And I calculated here, you see the variance as a function of the horizon. As you see, it increases very fast, even if you divide by T. In the previous table, I showed you that the variance increased tremendously. Now, even if I annualize it, it increases very fast. Now, some people may think, okay, here it does not increase up to 30 years. It's not true. This is because of the scale. Show me the next one, please. You see here I put a different scale. You see it starts increasing from the beginning quite fast. This is zoom in into the picture if I change the scale. So the annual variance, even if you analyze it, increases over time. This is the fact. Next one, please. So they know it. So what they suggest, let us take the variance of log return, log WT, which means what I did, suppose that I did bootstrapping 5,000 observation for 2 years investment. They take log of each of them and calculate the variance of log. And if you do it, you get, by the way, the scale, as you can see, is very, very tight. I mean, it's almost the same number here and there. So it also does not change. It's go up, down. It's just because of random samples. So it does not change. It's not going up and not going down. If you take log, it's well known. Next, please. Okay, the question that I asked in this paper or this research, should we take variance of log WT or variance average? Here should be capital T, sorry for the error. Should we take variance of WT or annualize? Are we allowed to take annualize? Second, should we take variance of log WT? What is the measure of risk? Or log WT over T, as Siegel and Pastor and Stamba did. They did this actually. Perhaps the correct measure of risk is pi, which means let us solve for the risk premium that we are going to pay to get rid of the risk. This is the only theoretical correct measure. However, the difficulty with this that it's changed from one person to a person. We want some objective measure. So pi is the best. If all of us would have the same utility function, the same preference, I would use pi. but we don't. So therefore, we need to go further something else, please. Okay, what is the correct measure of risk? Okay. If we know from theoretical work, not of mine, before me, if distributions are elliptic, e.g. normal, logistic, the variance of WT is the correct measure of risk index. This is, if you have mean variance, this is not what Markowitz said, but if you have normal distribution, we can prove mathematically that the mean variance is optimal. Markowitz objected to this because he said, I don't believe distributions are normal. They are not normal. And therefore, he said, I'm using approximation. If the returns are not too high, plus minus 30%. Actually, I published this paper with him in the American Economic Review. If it's plus minus 30%, then you see Markowitz approximation to expected utility. Then you are allowed to use mean variance. But I am not allowed to do it because if I invest for 30 years, you saw the variance there. Returns can be minus 80%, plus 14,000%. I mean, the distribution, we cannot use Levy and Markowitz approximation, which published in the AR on this topic. Okay, however, if distribution are log normal, then variance of log WT, not average of it, variance of log WT is the correct risk index. If distribution are log normal, the question, are they log normal? Okay. This leads us, we need information on distribution of return and whether the type of distribution vary with the assumed horizon. Why I'm saying that? Suppose that for 1 year investment, distribution is normal or close to normal. For 10 years, it cannot be normal. It gets positive skewness. It becomes log normal. So we cannot compare for all horizon the same mean variance rule or mean risk rule. We cannot. So we need to use distribution free like stochastic domain for that. Please, next. Okay, so my first task was, let me measure, remember I'm doing bootstrapping. Let me just repeat in one sentence so all of you understand. I have 100 years of observation, okay? If I assume that I invest for 1 year, I draw one observation and return it. One observation and return it. I do it 10,000 times and I have the distribution. If I invest for 2 years, I take one observation at random, second at random, multiply them. This is my first observation. Repeat it 10,000 times, I get distribution for investment horizon of 2 years. So far I do up to 60 years. This is the well-known bootstrapping technique. Later on I do something else. So here I did for, if you invest for 1 year, you see the distribution, and this is with many, many observations, it's nothing. You see the P close to 0 mean, students' distribution is the best approximation, but I cannot defend it. I reject it at 0 in alpha significant level. Go to T, beta is the best distribution. When I say best, I use, by the way, a program called Crystal Ball, if you heard about it. It takes about 50, 20 distribution, theoretical distribution, and find which one best fits the empirical data. So this is called Crystal Ball. I suggest that you look at this. It's a very strong tool for empirical workers. So then I did 10 T years. I got logmar distribution. Can you go to the next one, please? Look what happened here. 20 years, log normal. And by the way, when I see P861, this means we cannot reject a null hypothesis, even at P 80%, which means the fit is excellent. The larger the P number, the larger the excellence, the more intensive the excellence of the fitness of the distribution. So we see here almost perfect fit. Up, 30 years, almost fit, log normal. So I told you, remember the number 20? From horizon of 20 years on, log normal defeats all other candidates as theoretical distribution, and we get excellent fit, which means for 20 years or more, I can use the variance of log as the measure of risk. Please, next. Okay, here I did a table. You see here, you see 0 up to 1. By the way, I have stocks and bonds. Stocks and 10 years treasury bonds, which mean kind of a little bit risky bonds, government bonds for 10 years. And here, alpha is the proportion I invested in stock. So I invested 0 in stock, this is only bonds. This invested 100% stock, only stock, and here in the middle. And in the table, I put the best distribution which fits the data. Once again, bootstrapping, many, many observations, okay? You see the shaded area from about 2015, all shaded, which means all log normal. There's no competitor. Log normal beats all other distribution, okay? Which gives me the confidence to continue with the log normal distribution. So the first conclusion, if you invest for 20 years, I can tell you what you should do. Less than 20 years, 10 years, 7 years, actually, I don't know. If someone of you know, you will have an excellent paper, because we don't know what to do. Okay, next, please. Here is zoom in for the data from 30 years to 50, investor for pension. And this is stocks, 0 up to 50%, just larger numbers that you can see them. So all log normal. We don't have any other distribution, even though I gave chance to all distribution. Beta, student, T, chi-square, all of them here. And the log normal beats everyone, okay? Next, please. This is with S&P. So, what you saw the table before. Here are the distribution, only to observe them. Please go on. Not very interesting after the table. Please, next one. Next one, please. You see, by the way, as T go to 20, the distribution get positive skewness. If you get positive skewness, first it fits the log normal, but this means you cannot use the mean variance rule anymore. You cannot, because there is skewness. And we're interested in skewness. Look at here. For 40 years, please continue. Okay. Now, before one sentence which is not on the slides, I have another paper published showing that if distribution is almost log normal or almost normal, with small deviation like that, we never get perfect distribution, perfect normality, or perfect log normality. We get some deviation. So what I did, calculate the expected utility of the result precisely for different utility function, and then calculate it by assuming log normality, even though I know it's not precisely log normal. I have some deviation. And the error is 0.0001. I mean, you can do it safely. This is what I'm trying to say. Okay, now, the frontier should be, if you want really now to find the optimal mix of stock and bonds as a function of T for horizon of 20 years or more, which means log normal distribution, the frontier should be, you should maximize EW and minimize variance of log W. I guess most people don't know, we have a mix here. Here return and here log return. This is true only for log normal distribution. It's not true for any other distribution. And I proved actually many years ago, in 1973, in the International Economic Review, that what I proved here, that anyone who work according to this rule is maximizing expected utility. Every risk averter, exactly as Markovich did with the mean variance, I do here with the mean log variance with log normality. So anyone who selects portfolio by this rule, he maximizes expected utility. Okay. And this is what, by the way, what Siegel does and Stamba does and all the paper that I mentioned before is wrong, simply wrong. You should not do it. Because for log normal distribution, it's wrong. Okay, now, we need, what they do, Siegel in particular, they find the proportion alpha, which minimizes the variance of alpha x, this is bonds and stocks, and this is bonds. And he looked for alpha, which minimizes the variance. However, he assumed that x is log normal distribution, he assumed that y is log normal distribution, and we know from statistical theory that if it's this log normal and this log normal, combination of linear combination is not log normal anymore. So it's not log normal. You cannot do it. Okay? So they do theoretical mistake here. What they have to do is the following. You have to find alpha. No, go to the next one, please. Next step. Okay, what you do, You need to find alpha and invest in year T. Alpha in stocks and 1 alpha in bonds. This for 1 year. Keep this alpha and choose at random another year for stock and bonds and another year. And you have many years like that. Then when you multiplied it, this is what I did here, Z, multiply all this return. This is log normal. This is allowed. You don't allow to take the terminal value of two distributions and combine them. You should combine them at each year and then multiply, and by the multiplication, you get the log normal distribution. Okay, next please. This is the result of Siegel. He said if you invest for 1 year, the minimum variance portfolio includes 30% stocks. If we invest for 30 years, it includes 68%, which means that if you go from horizon 1 year to 30 years, stocks become safer. Why? Because you see 68% stock, and here, of course, it goes to 100. Here it goes only from 13% to 100. So stock becomes safer. You want to invest more in stocks by Siegel approach, okay? When he took, look what he did here. E of log, variance of log, which is incorrect measure of mean return. Please continue. Okay, the way that I did it with the correct method, I did the efficient frontier for 1 year, 5 years, 10 years, which looked very nice like a Markovich efficient frontier, even though I put here E of W and here variance of log W as we should. Go to the next, please. However, when I go to longer horizon, I got counterintuitively, I was surprised at the beginning. I told my assistant, let's check the calculation again, and again, and again, and finally I did it, and I got the same result, which means unless we are fully correlated, me and my assistant, this is correct result, and you get kind of curvature. There is no minimum here. I mean, the minimum is here at the bottom. There is some minimum. So kind of frontier that we are not aware of, don't know about it, simply because I put here variance of log and here the mean of return. Next, what? Okay. However, you see the zoom in, there is some curvature here, some little curvature that we could not see it earlier. So there is a curvature, and then it goes like that, like concave. Yeah, next please. What? Yeah. Okay. Now, I calculate the mean variance, I calculate the alpha, which minimizes the variance with the correct calculation. And you see that for T1, you should invest 40% in stock. For T60, only 1%, which means stocks, as the horizon increases, become indeed more risky. They are more risky. If you just want to look at one dimension at risk, they become more risky with the correct method. So with this respect, Siegel is correct. I also say it's more risky. Okay, and we can go to the next one. When I took variance correctly, the variance of log return of the portfolio, the same result. For T1, you should invest 42% in stock, and 60, only 1%. Again, even with the correct method, stocks become less risky. Next, please. Okay. Here I come to stochastic dominance, and I do it quick. How much time I have?
5 minutes.
5 minutes?
Yeah.
50 minutes?
5.
5, I'm sorry. I don't listen, I don't hear well. Okay, so I'll try to do it faster. Okay. If you give me 10, I appreciate it.
Okay.
If you want to compare T, 10 for, okay, I got 10. And I lost half a minute by talking to him. Okay, so let's go faster. We have 10 minutes, I'll try to finish everything. What we have here really, I want to compare risk for 1 year, 2 years, 5 years. We don't have common distribution anymore. So I want to use this stochastic dominance. And stochastic dominance say that F dominant G, stock, let's call it F stock, dominant bonds, if this occur. We mean the distribution of F is below G everywhere. This does not occur in practice. And here, which means really if F is smaller than G, every investor expected utility prefer F to G. Okay, go next. Second degree stochastic dominance. If I want to assume risk aversion, stock dominates bonds if this integral is positive up to every point X, okay? Which means if the integral exists, every risk averter prefer F to G independent of his utility function. I don't need to know the utility function. This is the beauty of stochastic dominance. I don't need to know the utility function. Okay, next please. And if you have log normal distribution, as I told you before, F domain G by SSD, I mean, SSD and this rule are identical. If the mean greater and the variance of log is smaller, there is SSD, if and only if. So it's the same. If you have log normality, just go work with the mean and log variance. Okay, next, please. Okay, and there is another rule which called almost stochastic dominance, which was published in Management Science. We said the following: look, this is the difference in expected utility. Okay, I can divide it into up to x0, up to here, where I call this area stochastic dominance violation. Remember, the yellow is stock. Stock is above bounds, it's not good for me. And B is the good area. So the violation area is the absolute value of A divided by F plus B. If this area A divided by A plus B is less than 4%, 3-4%, we did an experiment with hundreds of students. All of them prefer F to G, which means if the violation area is very, very small, we call it almost stochastic dominance. Why it's almost? Because we may have some crazy investor who may say, look, even this area is a tiny bit, 0.1111. I may have marginal utility infinity there, and I prefer bonds. We may have such a guy, theoretically. But in experiment with hundreds of students, all of them prefer F to G, as long the area epsilon is 4% or less. Let's go on, please. Okay, this is the empirical distribution. Look what happened. For T1, the cross widely. Epsilon is very great. It's this divided by this plus this is very large. When you go to epsilon 5, you see it becomes smaller. 10, smaller. 15, smaller. Continue, please. This is just for 20. And it seems that they don't cross each other. It's only because of the dimension is very large. This is the zoom in. They cross each other. For 30, they cross each other. Next, please. And for 60, you see almost they're identical, but this is the scale. Look, what's 20,000 here. So this is the zoom in. They cross each other. Okay? Continue, please. Okay. Now, I try to find if there is almost stochastic dominance, which means if the area which disturb me, which I don't like if I want to buy stock, is small enough to say I should have crazy utility function to prefer bonds. So I calculate epsilon for each distribution, and look what happened. Epsilon 1, forget about epsilon 2. Epsilon 1, for 1 year, it's 24%. If you invest for 1 year, you should not buy stocks, because violation area is very large. But if you invest for 5 years, you see it's 6%, 10 years, 1%, 60, no, I don't go this number. 20 years, it's 0.0068, where we know that up to 4%, the whole population will say we ignore this area because the profit that we get from stock overweighs so much. So we prefer stocks over bonds. Continue, please. Now, some people ask me correctly, okay, you work with samples. What about sampling error? So I did confidence interval. I don't bother you with statistical by Dvoretsky. Confidence interval to the cumulative distributions. Okay, next, please. And you cannot see it very well because it's the gray area there. This is the confidence interval of stock and bonds. And here also, continue, please. The idea is clear. Here you zoom in on the confidence interval. They're quite big. If you zoom in on them, please continue. And here, here I did something against stock. I took the following. Let's take the upper bounds of the stocks. You remember, the stock goes, the distribution go to up, it's not good. If it goes down, it's good because higher return you get. So I took the worst case for stocks and the best stock for bonds. I took the lower bound for bonds and the upper stock for stocks and said, okay, let's see if still stock win. Continue, please. And this is zoom in on the intersection of the 2 points. Please continue. Okay, here is the epsilon 1 with this upper bound and lower bound. You see if I take t equal to 1, the bounds are the epsilon is very big, which means we cannot say for 1 year that stock better than bonds because the violation area epsilon is very big. But if you go down to 20 years, even with the worst case for stocks and the best case for bonds, we have less than 1%, which means the area which disturbs me from saying for sure all of you should buy stocks is only 1% of the 100% area enclosed between the two distributions. Please on. Okay, no, this is important. This is important. Maybe this is almost the last view that I show you. Here I said, now someone criticized me correctly. You assume IID, the stocks are independent. Maybe they're dependent. You have to take it into account. So here I sample, as I told you, if T equal to 2 years, 1 and 2, then 3 and 4, 4 and 5, which means if there is any correlation between over time, when I take 1 and 2, the correlation is taken into account. So I took here case of the possible dependency, and I repeat the same thing, and look what I got. That for T equal to 1, stocks and bond, again, one intersection, quite surprisingly, and for Tn, you see the intersection here? This is the epsilon, what disturbed me, very little, even with dependence. Please, next. And here the epsilon with dependence. So you see for 1 year, it's 17, 18%, quite big. 2 years, quite big. I would not say buy stocks here. 3 years, 5 years. Once we start with 6 years, it's 2, 3%. We come to the safe area that I can tell you, buy stock, it's good for you, unless you have some utility function extreme, which give a lot of weight to the lower income, which is normally most utility functions do not do it, and you prefer that. Okay, next, please. Questions and answer session, if you want to ask me a question. First, as I repeat, I put there my email. It's very hard, intensive, to give you all these slides in very short period. This need at least 3 hours to talk slowly about it. But I see his eyes against me, and I decided to do it faster, not to take your time. And up to you. Question?
Okay, so I would like to open the Q&A part. We have a couple of flying students with microphones, so if you could